Welcome to the Wall Street Podcast. Today, we'll be discussing 5 top-rated analyst stocks paying over 5% in dividends, how Apple has been increasingly threatening the traditional banking system, and since tax day is coming soon, I'll discuss the IRS's plan for those who can't afford to pay all at once. Let's begin. In times of high interest rates, dividend stocks may struggle to attract investors. However, over the long term, increasing dividend payouts can contribute to share price growth. When evaluating dividend stocks, considering yield alone may be insufficient, as a high yield could signal potential dividend cuts. Before I tell you about the list, remember to always do your own due diligence before buying stocks or hire a licensed financial advisor. Also, the dividend rates may change after the making of this video. With that being said, this list came from FactSet's top analyst picks. At the top of the list, Comerica Incorporated, ticker symbol CMA, is a Dallas-based financial services company with 3 business segments: the commercial bank, the retail bank, and wealth management. Led by CEO Curt Farmer, Comerica focuses on building relationships to help people and businesses succeed. With banking centers in Texas, Michigan, California, Florida, and Arizona, Comerica is expanding its presence across the U.S., including new markets in Southeast and Mountain West regions. As one of the 25 largest U.S. financial holding companies, Comerica has the highest concentration of commercial and industrial loans among the top 20 U.S. commercial banks. Their current dividend yield is 6.56%. Second place goes to Citizens Financial Group Incorporated, ticker symbol CFG, headquartered in Providence, Rhode Island, is an American bank operating in numerous states and Washington, D.C. It was a subsidiary of the Royal Bank of Scotland Group from 1988 until its 2014 IPO, with the group selling its remaining stake in 2015. As of June 2022, Citizens operates 1,003 branches, 4 wealth centers, and over 3,100 ATMs across 11 states under the Citizens Bank brand. It ranks 13th on the list of largest banks in the United States as of Q4 2022. Citizens Financial Group Incorporated has a current yield of 5.77%. Third on the list is Healthpeak Properties, Inc. PEAK is a diversified real estate investment trust, REIT, specializing in healthcare real estate for life science, medical office, and CCRC tenants. Established in 1985 as healthcare property investors and joining the S&P 500 index in 2008, Healthpeak focuses on clarity, simplicity, and consistent execution for long-term growth. With over $20 billion of owned real estate, Healthpeak is committed to delivering value to shareholders, customers, and employees while creating consistent long-term growth opportunities for investors. Healthpeak Properties Incorporated. Their current dividend is 5.71%. In fourth place, Hasbro Incorporated, ticker symbol HAS, is an American multinational conglomerate holding company based in Pawtucket, Rhode Island. The company owns well-known trademarks and products, which include Transformers, G.I. Joe, Power Rangers, Monopoly, Furby, Nerf, Play-Doh, Twister, and My Little Pony. Their current dividend is 5.34%. If you're not interested in toys or games, Philip Morris International Incorporated also offers a dividend above 5%. Philip Morris International Incorporated, ticker symbol PMI, is an American multinational tobacco company whose products are sold in over 180 countries, with Marlboro being its most recognized and best-selling product. PMI, part of the Big Tobacco Group, was spun off from Altria in 2008 to focus on emerging markets. Though its legal seat is in Stamford, Connecticut, it doesn't operate in the United States, where Philip Morris USA, an Altria subsidiary, owns the brand rights. PMI's operational headquarters are in Lausanne, Switzerland. The company is controversial due to the addictive nature of tobacco and its history of concealing the health impacts of smoking, leading to litigation and restrictive legislation. Despite a decrease in smoking prevalence worldwide, PMI ranked number 101 in the 2021 Fortune 500 list of the largest corporations by total revenue. They currently offer a dividend of 5.11%. As Philip Morris International continues to be a major player in the tobacco industry, it is evident that businesses across various sectors face challenges from emerging technologies and changing consumer behaviors. One such example can be seen in the banking industry, where digital wallets like Apple Pay have disrupted traditional payment methods and forced banks to innovate and compete. Over the years, banks have tried to launch their own digital wallets, but Apple Pay had a big advantage over its competitors when it was introduced in 2014. This is because Apple Pay was the only digital wallet that banks agreed to pay a fee for every transaction, and banks make money on debit and credit card purchases from interchange fees. Apple Pay is still what most people prefer, and Apple collected an estimated $782 million from Apple Pay last year. The growth of new financial technology has caused banks to worry, and they are now trying to compete with their own digital wallet, called Pace, which will be operated by a company owned by 7 major banks. The banks have also introduced their own new tech in the last few years, such as tap-to-pay cards with similar technology to your phone that makes it just as easy to check out in store. If you use Apple Pay, the bank has to pay 3/4 of a cent to Apple rather than pocketing 10 cents on a $5 transaction, so they would instead keep just over 9 cents. This is a very clear-cut example where the banks have had enough and are trying to figure out a way to compete against Apple Pay and PayPal. Still, the banks will only succeed if people actually use it, and merchants agree to accept it. Apple's subsidiary Apple Financing LLC will be the lender, effectively taking over the role that many banks and other financial institutions would usually take. The challenges faced by banks and other industries in adapting to new technologies and consumer preferences are not unique. Similarly, individuals often encounter financial difficulties that require them to seek alternative solutions, such as those available for taxpayers struggling to pay their taxes on time. As tax day approaches, many people might be struggling to pay their taxes on time. If you find yourself in this situation, don't panic. There are options available, such as the Internal Revenue Service (IRS) installment plan. This plan allows taxpayers to pay their tax liabilities over time. The IRS offers 2 types of installment plans: short-term payment plans up to 180 days and long-term plans known as installment agreements. These agreements enable you to pay your tax bill over an extended period, sometimes even a couple of years. Short-term payment plans require no setup fee and are available for taxpayers with a combined amount of tax, penalty, and interest of less than $100,000. Long-term installment plans, on the other hand, charge setup fees depending on your chosen payment method. If you enroll in a monthly automatic withdrawal system, the setup fee is $31. Paying every month online incurs a $130 fee, and paying by mail, over the phone, or in person costs $225. For low-income taxpayers whose earnings are at or below 250% of the federal poverty level, the IRS may waive or reduce the setup fee. Keep in mind that interest and penalty charges will continue to accrue on your unpaid balance until it is paid in full. In tax year 2022, nearly 2.4 million new installment agreements were established, and taxpayers paid a total of $13.8 billion toward all installment agreements. While the installment agreement is a popular choice for taxpayers who can't pay their tax bills in full, it is not suitable for everyone. Penalties and fees can make this option more expensive than other alternatives. Taxpayers should consider their financial situation carefully and explore other options if an installment agreement is not the best fit. For low-income individuals or those with special needs, there are additional payment alternatives such as offer in compromise, currently not collectible status, or bankruptcy. The offer in compromise allows taxpayers to settle their tax debts for less than the full amount owed, while the currently not collectible status may apply to those whose income is below their basic living expenses. Bankruptcy may also be an option for discharging tax debt, but it's essential to consult a bankruptcy attorney with expertise in tax policy. The critical thing to remember is not to ignore your tax obligations. Avoiding engagement with the IRS can lead to automatic collection actions, such as garnishing your wages or seizing your bank account. Instead, reach out to the IRS to discuss your situation and explore the available options. In conclusion, if you're unable to pay your taxes on time, consider the IRS installment plan or other payment alternatives. Engage with the IRS to find the best solution for your financial situation and avoid severe consequences, such as wage garnishments or bank account seizures. By being proactive and seeking help, you can work toward resolving your tax debt and regaining financial stability. That concludes today's episode. If you found this content valuable and informative, please like and subscribe. See you next time.